Okay, well, hello everyone and good morning. Welcome to what is sure to be a very informative webinar on quite a popular topic these days in our industry, home insurance. For those of you who may not be acquainted, I'm Jeremy Davidson. I'm chair of the SFAR Education and Events Committee, and we are thrilled to be in collaboration with the SFAR Government Relations Committee and this webinar's planning committee to bring you this esteemed panel of insurance experts. You're in for a real treat today. I'll hand it over to Joel Lupkeman, head of the committee's insurance working group, who will share the structure of today's webinar and introduce us to the panel. Just a quick housekeeping note, if you do have questions, the chat is not functioning for this webinar, but we do have the Q&A section available to you. So please type your questions in there. They will be monitored. And then at the end of the webinar, we will have a robust Q&A section. Take it away, Joel.
Great. Thank you so much, Jeremy. Genevieve, can you bring up the next slide? So what I'd like to do is introduce our speakers for this morning. First speaker will be Sanjay Wegle, and he is Senior Vice President of Government Affairs at the California Association of Realtors and has been with the association since 2003. As the chief lobbyist for CAR, he supervises the policy and political work of the Government Affairs Department. The Government Affairs team includes advocates who work to advance the policy and political goals of the association. Prior to his work in government affairs, Sanjay served as an attorney for CAR's Member Legal Services Department in Los Angeles, helping realtors navigate an array of legal issues. He has published several articles on legal topics affecting real estate licensees. Sanjay received his law degree from the University of Southern California, a master's MA from UCLA, and a BA from the University of Chicago. He lives in Folsom with his wife and sons. And so, Sanjay, why don't we go ahead and start with your comments, and then I'll introduce, when we get to the next area, I'll introduce the other panelists for this morning.
Sure. So I'm going to be talking about basically the legislative lay of the land. So Joel.
And Sanjay, yeah, Genevieve, can you bring up the next slide? And one more. One more. And one more.
Okay.
Great, thank you.
All right, so I'm going to go ahead and kind of launch into basically the insurance, and I am just going to use the word that's on screen, crisis, in the state of California. I noticed, Joel, you said earlier, it's a popular topic. Popular in the way of everybody's paying attention to it, but I don't know if anybody's happy about it. So so first let me go what CAR is doing, what the problem is, and how hopefully things get addressed or move forward in the future. The California Association of Realtors, we are supporting, and we are part of a coalition of groups that are supporting the Department of Insurance sustainable insurance strategy from the Department of Insurance. And that is a strategy which aims to eventually first stabilize our market and then allow more insurance companies to start coming into the state. Here's the complication, and a lot of this has to do with our FAIR plan. I'm sure most people on this call are aware of that, but the FAIR plan is the insurer of last resort in California, although in many communities it is now the only available insurance source. In California, if FAIR plan has problems, which it currently does in terms of its fiscal position, the way it works, it does not go direct, it does not go to the taxpayers. They assess the insurance companies based on the insurance company's market share within the state of California. And if the insurance companies then cannot afford to cover that assessment, they actually do have the authority and the power potentially, if it's approved, to assess policyholders as well. So that risk, that if FAIR plan, which we've seen it kind of basically happen right now in the Palisades and partly in Altadena, but more the Palisades, because of the risk of catastrophic loss by the FAIR plan, insurance companies They generally are not leaving the state, but they stop issuing policies. You saw that with State Farm and a number of other companies. When some of the big companies stopped issuing it, small companies would come in, and then they would stop at a certain point. Like maybe they have 8% market share and they stop, 7% market share, 5%, up to whatever percentage they feel is comfortable because of what might happen with the FAIR plan. That's why you often, again, will see insurance companies not necessarily leaving our market, but stop issuing because they're afraid of the exposure they're going to have if FAIR plan runs into a problem like it just has. And on their own books, that's then a looming potential fiscal problem if they can't absorb that. So they have to be aware of what that FAIR plan risk is. So how does the sustainable insurance strategy address that problem? First of all, it gives the insurance industry two things that they have wanted by regulation in this state, which is the ability to use catastrophic risk modeling, which is the ability, current law, and we are the only state in the country that does not allow insurance companies to do this, allows them only to look backwards at their claim history in terms of for setting rates. Allowing them to use catastrophic risk modeling will allow them to look forward. So they can assess, and by the way, completely reasonable given climate change. The argument has historically been, wait a minute, we're in a much more dynamic environment in terms of the way the climate and climate change, et cetera, so that there should be modeling tools that will allow us to look forward and not just backwards. The Department of Insurance has issued regulations, which is going to allow that to start moving forward. Also, insurance companies in California, again, the only state, are not able to capture their reinsurance costs in their filings. They are going to be able to, in a limited fashion, also be able to capture that. So you're sensing, oh, when they file for insurance premium increases, that means they're going to have more tools to raise your rates. And bottom line is yes. All these proposals to help reform and get the insurance market back in California are likely to lead to higher rates, especially in higher risk areas. But the key is at this point to get availability again, to get admitted insurance companies to come back. And if the way the plan works is if they want to take advantage, which the insurance companies definitely do, of those two aspects, they have to start writing in areas where there's a lot of FAIR plan penetration. So what that would do is if you're writing policies in areas and you're taking pressure off the FAIR plan, reducing basically their exposure, that reduces the risk to all the insurance companies, right? So less risk if FAIR isn't writing as many policies. That should allow those companies then to be able to take on more risk within California, and hopefully you get a circle of things finally stabilizing our market. So a couple of years ago, I did a podcast with a representative of the United Policyholders, which is a consumer group, and a representative of the independent insurance agents, who we actually work with a lot. And they were both like, well, if we can have 2 years without fires, maybe the whole market could just stabilize. Well, that's apparently never going to happen because, as you saw, we just had the Palisades, and which were major, major losses. And the constant flow of fires is really causing disruptions in our market. And the sustainable strategy should eventually, again, reduce that risk, but it's a problem. But we are supporting that strategy, and we do believe that it will help. We have spoken to a number of experts in the field. If this strategy, frankly, had not been implemented and was not in the process of implementation, what happened in Palisades and Eaton would be far more devastating. Because right now, for insurance companies in this state, there is a sense of hope that, okay, this strategy should work. They were already assessed. They're ready for loss, right? To some extent, the ones that they were still insuring in the Palisades and Eaton Fire, they're ready to absorb these losses. And they can go ahead and look to a future where once this all starts working, that they can then start issuing policies more. So it absolutely would be the case that if that was not working, if that had not been in place, we would be in a much worse situation right now. So that is basically, as I've covered, the legislative and regulatory efforts. Now, in terms of legislative, everything I've talked about is on the regulatory front. And there's one reason one big reason for that, which is legislatively, this is a tough one, right? One of the reasons everybody's kind of letting the regulator of the Department of Insurance do this through regulation, which they do have the power to do, by the way, is anybody who votes for reform is basically voting for higher rates, right? And while, yes, you can probably explain to the public, I had to vote for higher rates, we are in a state which has very well-funded groups that would probably attack that person, right, for taking a vote. They voted to raise your insurance premiums. They are the problem. So our legislators are often quite reluctant to, to vote for some of the harder choices here. That doesn't mean that they won't, if necessary, but I think they're happy to let the regulatory system work and keep going forward. Now, there is a big question once Ricardo Lara, the Department of Insurance, is going to be termed out, and there is concern, since this is regulatory, who's the next Department of Insurance? So there might be a move to put some of these things into law prior to his leaving, to make sure that they can't just be kind of undone by a potential future regulator, which could lead to a real insurance crisis. A greater crisis within this state. Just going back to the FAIR plan for a moment, as I mentioned, if they end up in a problem, they can always keep issuing policies, which they are, but they have been given permission to assess the insurance and to have assessments of about $1 billion, which does open the door to the potential. And when they announced this, there's all these media stories like, oh, California homeowners are going to be liable for $500 million out of their policies. It's not as clear cut as that. There's reinsurance costs, there's everything. This is all still being worked through. What will the actual costs be is not clear. But yes, they have assessed, and the insurance companies are going to have to pay something to help the FAIR plan stabilize. There is legislation that we are supporting and other groups to help stabilize and give the FAIR plan more access to resources to make it stronger. But these are all concerning issues to make sure that FAIR stabilizes so that we can always have a last resort insurance policy in the state of California. What is our position and role? Currently, we are primarily within coalition. The coalition that we are a part of involves most of what I will call the shelter side of things: the California Business Industry, Business Properties Association, mortgage bankers, the Apartment Association. Insurance agents are part of this coalition, not per se the insurance industry. Insurance agents have, I think, a slightly more nuanced interest. Of course, they represent insurance industry interests, but they have a compelling interest since they're the agents, and they don't making sure that homeowners can actually get coverage, right? Because they are the agents who represent the homeowners, are often the first contact. So we are working with that coalition in order to help remedy the situation, and working with the Department of Insurance. If there's been any complaint, I suppose, from the industry, if you talk to the industry, is really just that they wish that everything was moving faster in terms of the Department of Insurance. Some of that is just the inherent regulatory system we have in California that tends to move a little slower, but many of them, I think, would say we wish it was moving a little faster. I did a short podcast recently with a representative of insurance, a consumer group, and the insurance agents. And I think the insurance agents gave like a B or a B plus to the effort of the Department of Insurance, and the consumer group gave an A, simply saying, listen, nobody else has a solution. You're going to hear all sorts of people going, what they ought to do is, but there is a fear. A lot of the people who are talking that way and were potentially going to introduce legislation have backed off, because everything is very fragile right now in terms of the insurance industry. So we're not really going to see, I think, major legislative efforts until we see the full ramifications of the Palisades and Eaton fires. And
Right.
There you go. Thanks. Happy to take the questions later.
Yeah, absolutely. Thank you so much, Sanjay. And Genevieve, can I ask that you now go back 2 slides? One more. One more. Okay, great. So I'd like to introduce our speaker, our insurance professionals panel this morning. So the first one, Ali Lopez, is a personal insurance consultant with International Pro Insurance Solutions, LLC. She joined Proco in June 2014 and has an extensive understanding of the ever-changing market and the region's distinct insurance risk, with a particular focus on designing and managing programs to meet the needs of high net worth clients, and real estate agents. As a personal insurance consultant for Proco, Allie's responsibilities include working with affluent individuals and families to protect their personal wealth, creating insurance programs that help mitigate the financial risk associated with the client's complex lifestyle. Allie was born and raised in Marin County, where she currently resides with her daughter and enjoys volunteering her time as a mentor to a local youth group. Allie is a huge advocate of nonprofits and has contributed to organizations such as Home to Home, Because Justice Matters, and Habitat for Humanity. Leah Nishi has been a farmers insurance agent since 2016. In addition to offering farmers insurance products, she recently formed the Nishi Insurance Agency, which is a brokerage that works with a variety of carriers to help clients navigate today's challenging insurance market. Leah and her growing team specialize in home insurance, working with both homeowners and landlords to secure protection for their property. In addition to home insurance, she also writes commercial and life policies. Leah's offices are in Alameda, and she also lives with her husband and her son. She is a graduate of Tel Aviv University. And Ian Hansen is Associate Vice President and Director of Personal Lines in the San Francisco office of Burns and Wilcox, an industry leader in providing specialty wholesale insurance solutions with 60 offices throughout North America. With 16 years of industry experience, Ian leads his team with expertise in the areas that include high-value homeowners coverage, not admitted high net worth, earthquake, and watercraft. Ian's efforts have taken the San Francisco office from the 10th largest to the 2nd largest personal lines department for Burns and Wilcox. Ian's efforts have earned him a CIC designation, top 10 in overall production nationwide, top 10 in new business production, as well as the Kauffman Leadership Award. Ian graduated cum laude from the University of San Francisco, where he earned a BS in business administration. He is also a graduate of the Kauffman Emerging Leaders Program and began his career with the Federal Deposit Insurance Corporation, later accepting an underwriting position with Crowley and Warren Insurance Services before joining Burns and Wilcox in 2008. And thank you guys once again for taking time out of your busy schedules to speak to our association this morning. Genevieve, can I ask you to move forward 3 slides? One more. And one more. Okay, so to lead off the discussion with our insurance professionals, I'm going to ask Allie and Leah just to give us a little bit of a lay of the land today, where we're at today and where you think we're at versus a year ago. Have we made more progress? Are there more insurers in the market? What are your thoughts?
Sure, I'll kick us off. So I mean, as Sanjay said, insurance has been a challenge for quite some time throughout the state, but I think that for our San Francisco audience, they really started to see the impact in 2023 when we're now almost exactly 2 years of State Farm pausing their new business. So as far as limitations on what's available, there hasn't been as much progress, but I do think in general, whether you're in the industry or just an average consumer, you have a better understanding that insurance isn't a joke. You really want to look take a deep dive into what's available, what requirements are being asked of the carriers that are still writing. And I think at this point, it's viewed, knowledge is power. So what can be learned about with each carrier, what options there are, and especially post LA fires, a big wake up call for any current owner or someone who's looking to buy on what is available. But I mean, fortunately, unfortunately, we've already been in this for a year. It hasn't necessarily gotten better, but it's I do see a light at the end of the tunnel.
Yeah, to sort of piggyback on what Allie said, which was perfect. And what we're doing, I think there's also a big change between where we were December and January 3rd and where we were sort of after the LA fire. I think at the end of last year there was a lot of progress, kind of following up what Sanjay said, with the CDI, the Department of Insurance, and some things coming down the pipeline about how they were going to allow reinsurance and things like that. And there was this optimism. And then we had the LA fires, and I think everything kind of reset. And also to Allie's point, which is important to the realtors, I think that people are so much more aware of insurance problems now than they had been a year or two ago. I know in our office, I'm sure Allie's the same way, we're writing multiple preemptive quotes before people even put bids in, because clients and agents are really starting to realize that insurance could become a deal breaker. Costs are up and things like that. So I think people are a lot more aware of the situation. But I think if we had done this webinar in December, we'd be like, things are going well, we're going to see people back in the market. And now I think we have a continued long road ahead of us.
Great, wonderful, thank you. Genevieve, next slide. Okay, so I'd like to turn it over now to Ian for a few comments. And maybe first, Ian, just talk a little bit about the role of an underwriter in the insurance business, and what's your sort of role in helping folks get insurance quotes or not. And I know you deal exclusively with the agent, not the consumer, but and then also obtaining coverage.
Yeah, so we're on the wholesale side. So obviously carriers have different distribution models. You have captive carriers, Farmer, State Farm, AAA. You also have direct to retail, direct to consumer, Mercury, kind of the branded ones that you've heard of. The carriers that we represent only distribute for the most part on a wholesale basis. So we're an access point for those carriers. Some of the we have national programs, which some of the carriers might have heard of: Lloyd's of London, Scottsdale, which is Nationwide's non-admitted paper, Lexington, which would be AIG's non-admitted paper. But then we also represent kind of program business. That's the MGA portion, which is kind of specialty markets and programs that are only accessed on a wholesale basis. We come in when it's not be able to place on the retail side. So whether it's Farmers, whether it's an independent such as Allie, they have the carriers that they represent in-house. If they're not able to place it within those carriers, they then go to a wholesale broker who we're able to place coverage generally amongst the carriers that we're able, that we represent. In a soft market, all wholesalers are similar on the markets that we represent. In a hard market, because there is limited capacity, it is really important to realize that wholesalers each have unique products amongst themselves. So we don't all operate the same on that basis.
So Ian, would it be fair to characterize you as the insurance agent's insurance agent?
Yeah, we're last resort. We're a bigger presence in the market today, obviously, than we were 5 years ago, and we are becoming more of a norm in California. If you look at California as a whole, prior to Camp, which was similar to our kind of Katrina for Louisiana, that was a turning point of a market. So prior to that, I believe California was about 97% admitted. So when you hear non-admitted, when you hear wholesale, that tended to be, properties with losses, poor condition, very rural, unprotected. Now, we represent a very healthy part of the market on the better risk. So we're a solution because admitted have dried up. That's why you're kind of seeing non-admitted carriers enter more so than you had historically in California. But if you go to a true E&S state, Florida, some of the coastal ones, it's probably about 20% of the market, where again, we were 3%, in the past 4 or 5 years, it's, I believe, probably doubled, but we're still as an overall market, very minor on new business portion, probably pretty present. And that is newer. So you're seeing us more so again than you had in the past, because pretty much everything was accommodated on an admitted basis in California, not the case, as most are aware that admitted dried up in a sense for now.
Yeah. And so Ian, can you talk a little bit about who are and what is a non-admitted carrier, and how do they differ from traditional carriers?
So traditional admitted, quote unquote, preferred carriers are regulated by the California Department of Insurance. Files are approved, rates are approved. They tend to be the branded ones that kind of consumers would be aware of. Non-admitted, or another alternative term for us, is surplus lines. So we're supposed to be kind of the relief valve. If admitted dries up, we come in as a market. A couple of examples historically where we're able to alleviate pressure on the admitted market would be, I believe after the Los Angeles earthquake, where carriers had to offer earthquake coverage, it dried up. So admitted, we're able to place rates, and we're not regulated by filing form. But probably more relatable example would be right now. Carriers aren't able to write. We had these huge fires. It did soften. The market did soften quite a bit, and we saw more people coming in early last year, December. We have the Palisades fire in California. It's putting admitted back to a stop. Non-admitted are able to adjust, on a dime. So instead of pulling out of the state or stop writing, what they're able to do is adjust rate. So we're continuing to write. We haven't stopped. And there is a viewpoint that non-admitted are unregulated in that sense, but that's not the case. They're regulated by the Department of Insurance. They're regulated by the Surplus Lines Association. They're also regulated on rate by the market in itself. So theoretically, if we want to charge a certain price for a risk, that is going to be regulated by competition in the state.
So, Ian, just to paraphrase, go ahead.
One last comment on that, on it being a non-admitted carrier, doesn't mean that we're any less financially viable. So, any carrier that's represented for most wholesalers are going to be B+, but primarily A rated. And they also do have, one of the benefits of admitted carriers are that they're backed by the California Guarantee Fund. So there's a certain amount of availability if they do become insolvent. Every carrier that we represent is going to be A rated. Again, nationwide is going to be Scottsdale's paper, Lexington's AIG, Lloyd's of London, one of the more reputable programs out there. Their policies more financially sound than an admitted program in California. The fact that they have a central fund, so their policies are 100% backed by Lloyd's central fund. So in the event they any one syndicate became insolvent, that is backed 100% by Lloyd's of London. There's no limitation on that.
Yeah. And the last question I had here is, how are they able to compete in the current market? So just to paraphrase what you said is that they can charge whatever premium they feel they need to make that risk that they're taking on make sense, whereas the admitted carriers can't. Is that a fair characterization?
Yeah, the admitted, pending rate approvals by the DOI, but they are not able to. So they don't have the same flexibility on rate, nor do they have the flexibility on form that is available in the non-admitted market.
And then you mentioned that they have the ones that you represent have certain ratings. And is that an AM Best rating? Who does those ratings?
Yeah, correct. AM Best, Standard & Poor's.
Yeah. Okay, well, very good. Genevieve, next slide. Okay, so for Ali and Leah, I think Ian covered a lot of this, but I just quickly, from your perspective, why are the non-admitted carriers increasingly being presented as an alternative insurer to the big name carriers, and that would be the Allstates and the State Farms and Farmers, and that traditionally dominated our market?
Yeah, I can start with this one. It's just because those carriers, the admitted carriers, have stopped writing new policies or become really restrictive on the policies they write. So as Ali said, I remember Memorial Day weekend of 2023 when State Farm pulled out. That was a big day to be a farmer's agent. And then with Allstate had pulled out a year before that in November, and that's writing new policies. They're just not taking risk on their books right now. So we're just having to go to the non-admitted market. People are becoming more comfortable with it because it's what's available. And as Ian said, they are well rated. Some of them are very, very strong financial ratings. So I think people have just become less scared by it.
Yeah, well, thank you. And Ali?
Yeah, I was going to say, Leah put it very simply, that just availability, pure availability is a big reason why we're seeing non-admitted as options, or at least more of an option. You also have to consider the nuance for each buyer. So there are admitted carriers that are writing, but they're going to require either certain, automatic water shutoff devices that the buyer can't fulfill, or certain, preventative, loss preventative measures that the buyer can't fulfill, or even as simple as a full package. So home, auto, and umbrella, a lot of the admitted carriers just want the full package, and the buyers may not be in a situation where they can move their auto or want to move their auto. Maybe they've been with AAA for 30 years and they don't want to move it to, Travelers or whoever. So there's just really niche situations with buyers in particular that all what's available to them in this season is a non-admitted company.
Thank you. Genevieve, next slide.
Oh, one last comment actually on that last slide.
Yeah, go ahead.
Yeah, one thing that also changed prior to camp is the way carriers manage their aggregate in California. Prior to camp, it used to be, who's your neighbor insured with? And if it's State Farm, they'd probably be one of the, that's kind of who you approach. It's almost the opposite now. So if you ask your neighbor who they're insured with, it almost takes that carrier out because, prior to carriers looking at California as a catastrophe state, there was almost unlimited availability. Now each carrier, I believe the largest 7 riders in California account for about 70% of the homeowners market. With that, in any one area, they have a finite amount that they'll write, and that box is much smaller than it was 4 or 5 years ago. So, when one carrier stops writing, similar to State Farm, the remaining 6 or 7 big ones are not able to take on the additional capacity. So it's changed the way they've managed risks, and it's a finite amount in any one area. That wasn't the case necessarily 4 or 5 years ago.
Great. Well, thank you. So for Ali and Leah, I think a lot of this has already been answered, but just give you another shot at it is that, how do you decide which non-admitted carriers policies you're going to offer? And I think there is a lot of just, even with agents in our association, there's the perception that it's non-admitteds are very risky and should be avoided. Fair plan maybe is even better than non-admitted. So maybe you can talk a little bit about that screening process.
Sure. So, again, we have grown our portfolio of non-admitted carriers available. When we have exhausted all admitted options, then we pursue the non-admitted options. Again, we just look at what the client situation is, what the characteristics and circumstances are for the exact home, because there are some non-admitted carriers that won't offer on even a pre-1900 built home, or again, if there is certain type of electrical. So we really try to find the right carrier for that specific buyer client.
Right.
Yeah, it really comes down to, like Ali said, what the situation is. We're obviously going to try admitted first. But we have things like galvanized pipes have become an issue. Admitted and non-admitted carriers who won't take them now. Knob and tube is an issue. So it's really kind of trying to find out the age of the home, the valuation. We run into a lot of valuation issues. There's fewer carriers. I'm sure Ali knows too. And they like above 2 million dwelling, that's the replacement cost, not the sale cost, but that still gets used up pretty quickly. You're really, as I'm sure we're running all the time, like a little tally in our heads of how to place, all the criteria of each house to find the carrier that will work for the client. So right. It's a lot of keeping stuff straight all the time.
Great.
Like a
Great.
giant puzzle.
Yeah.
Every time.
Thank you. Thank you. Genevieve, next slide. Okay. So, just a little rundown on, I think you've also already addressed a lot of this, but what are the type of risks that you tend to send to non-admitteds? And I think you've talked a lot about that, but anything else you want to add here based upon the bullet points in this slide?
Loss history. So let's say it's a perfect, clean risk, brand new construction, even no knob and tube, perfect roof, but the owner has poor loss history. So that will likely have to go non-admitted, or high profile clients. So again, think of a perfect risk home, but they're, now social media celebrities are becoming a thing, or, whatever you want to call it, TikTok, Instagram. A lot of carriers don't want to write those high profile people. So those are ones that are also being added to the non-admitted carrier list.
Interesting. And, I just want to touch on one of these things, course of construction also. And I think maybe a lot of our agents, they don't have an understanding of what that means. What are the limitations of course of construction, where that would come in. We'll talk about a little later in the presentation about knob and tube specifically, but where do you see course of construction playing a role in our market?
We mostly do it with either house flippers or ground up ADUs. So ground up ADUs are very easy. That's a simple course of construction project for people building it in their backyard or a plot next door. Those are easy. We do get a lot of house flippers, people who are taking these old houses and not going to move in and going to do a pretty gut rehab. Those are all course of construction. And their underwriting really depends on the carrier, the scope of work. Any kind of foundation work is generally tougher to write because that's a big risk. But for the most part, there are options available. We would just need to know scope of work, licensed contractor, valuation of work, and then we can value either the existing structure and the renovation or just the renovation. There's a few different ways to do them. They do take a little bit of time usually to get those approved because typically underwriters will have more follow-up questions, particularly if it's an older home, like 100-year-old home that they're doing a lot of work. They're going to want to see existing condition. But course of construction is really different than going in and replacing the electric, replacing the plumbing. Typically that can be done just with your homeowner policy. It's a pretty quick thing. Course of construction is more if it's going to be vacant and there's going to be workers in there for an extended period of time.
Great. I just want to touch one other thing, full-time versus short-term rentals. You know, in San Francisco, Airbnb hosting is a big deal, probably less so in other parts of the Bay Area. And if you have an Airbnb in some portion of your house, does that present unique risks that maybe an admitted carrier may not take the policy?
Yes.
Yes.
And so you would have to write a special policy for that then. Okay, great.
Yeah.
Genevieve, next slide. Okay, Leah, I'd like to have you talk a little bit about Fair Plan, and I'll turn it over to you on this one.
Gosh, we have talked a lot about Fair Plan today, but it is sort of the big elephant in the room that is there and no one really knows how to manage. I did see there was a question that came up also. It said, what if all these carriers pull out? What happens to the Fair Plan? Yeah, that's the problem that I think a lot of these companies are worried about. So when I started, we used to write maybe, one Fair Plan a month, and it was someone up in Tahoe or way up in the hills or something like that. You couldn't find insurance. Right now at my agency, we're probably writing 5 to 6 Fair Plan policies a week. It seems like we are doing a lot of business there. It's because we do write a lot in the hills, Oakland, Berkeley Hills. So we're getting that fire line restriction is getting tougher and tougher. But we also use it as a Band-Aid policy for homes that have knob and tube. I'm in Alameda, which is the land of old homes with knob and tube. I can't get sellers to get it out. I understand they don't want to open walls. I get it. But for our buyers coming in, because we don't have an admitted carrier and I don't have any non-admitted carriers that will take active knob and tube, what we're doing is we're kind of Band-Aiding it through the Fair Plan, where we can issue the policy. We can also get them a standalone liability policy to at least give them some protection there. And then once they get the work done, we're able to quickly move them out of the Fair Plan and into either an admitted carrier or non-admitted carrier, depending on other risk factors. Couple of positive things on the Fair Plan. One is a couple of years ago, they went up to $3 million total insured coverage as opposed to 1.5. So we do have a little bit more room to protect clients, but even so, 3 million goes really fast, as my clients in the Palisades and Altadena have learned. The turnaround time for the Fair Plan has gone much, much, much better. A year ago, it was taking 2 to 3 weeks to get applications in. Now, as long as we submit pictures and replacement cost documents, you can almost get something back instantly. So we are able to turn around policies really quickly, which has been a good thing. Same is not true on the commercial side. While the commercial Fair Plan has expanded significantly and it's gone up to $20 million of insured coverage, and coming, I believe soon, it's going to be $20 million per structure per commercial policy to help account for these HOAs that are getting dropped. They are increasing. Those do take quite a bit of time to go through. They are really scrutinizing those applications. But we can issue Fair Plan pretty quickly, and we are using it quite often as sort of a Band-Aid policy to get people through escrow. We have really detailed conversations with the clients about what's covered, what's not covered, make sure everyone's on the same page, but it's a way for people to get into these older homes that have knob and tube, especially if they're going to go in and do the work.
Okay. And do most insurance agents offer Fair Plan? So, you know, let's say if you were an agent with Allstate or somebody like that, they would also do Fair Plan.
Yeah, I think almost everyone can issue Fair Plan, and Fair Plan's the same no matter who's writing it, as long as the input's the same. It's not like as an agent, we have some sort of separate deal with the Fair Plan. any agent in the state who's writing the FAIR plan, if the input's the same, the output's going to be the same.
Okay, great.
The only
Next
major
slide.
difference would be for the difference in conditions policy. So if you were to write the wrap, that's where different agencies or brokers have different products for that.
Yeah. And to Alex, the difference in conditions, so in a traditional FAIR plan situation where you're writing, let's say up in the hills or up at Tahoe, these high fire risk, you'd have both the FAIR plan policy to cover fire. It also covers airplane strike and windstorm. And then you have what's called a DIC or RAP policy that covers water, liability, theft, and you combine both those policies to make a traditional home policy. What we're finding is that because of knob and tube, that second policy doesn't exist. These carriers don't want to write that second policy, even though they're not covering fire risk. But we do have some companies that will at least issue the liability, so we can get you 3/4 of the way there, and also hopefully use that as a carrot to get that electrical updated so that we can get you off of the FAIR plan. FAIR plan does not charge a cancellation fee. They refund your money quickly. They are happy to have your business off their books.
And then one thing to add on that, on the E&S, on the kind of wholesale side, we also have products to supplement the FAIR plan. In addition to DIC, we can do contents only, or if you're limited at 3 million and a loan requirement, or you want to insure the value, you can offer products excess of the FAIR plan on a property basis. So up to 10 mil excess, I can think off top, but we have multiple markets coming in trying to fill in that gap that's in the market right now. So there are products to supplement to get more similar to whole policy, but probably some gaps that you don't want to deal with.
Okay, great. Genevieve, next slide. Okay, so just some of the issues that you've already mentioned, but just thought we'd touch on some of these and just some of the best practices that agents might want to convey to their homeowners, either who are purchasing or preparing to sell. So older homes, and Allie, I know you mentioned about homes older than 100 years. Can you talk a little bit about that?
Sure. So, over 100 years old is really the time frame that the carriers are looking at. Some can, have a stop at anything pre-1900, but every once in a while we come, get an 1890 home or even older. So the availability gets smaller for those homes, anything pre-1900. It obviously gets flagged when entering it into the system. It'll ask, what type of plumbing, when the roof was last updated, knob and tube, or even certain electrical panels are starting to become ineligible with several carriers, admitted and non-admitted. Best practices that I've communicated is, again, if in a perfect world, a seller will take care of these items, but there's, I'm sure everyone's dealt with a situation where the seller either can't, they don't have the time or the financial ability to take care of these items. So, as a proactive measure, obtaining a bid from a licensed electrician or contractor to have these things, to show that the buyer is going to take care of those things pretty quickly. We vet a lot of our carriers that we start working with. We explain that 90% of our leads are via new home transactions. So we ask ahead of time, do they have a grace period to have these items addressed if we can bind coverage?
So you're finding that you are today able to, with the appropriate carrier, bind coverage with the knob and tube, as long as, and maybe you can just repeat yourself there, what are the conditions that you're going to want to see in order to bind coverage with existing knob and tube, and how long will the prospective buyer have to get that corrected?
Yeah, so case by case basis, but let's say it's a good, everything else on the home is good except for the knob and tube or except for the panel. If we have either a signed contract or a bid from a licensed electrician, we use that in the submission process to underwriting, and then they usually give up to 60 days, depending on the carrier, for the buyer to, 60 days post-closing to have those items addressed.
Okay. And any other layered risk issues? So, I mean, that being able to do that, that's huge. So are they looking for any other more significant conservative underwriting to mitigate a binding with the existing knob and tube?
And one thing though, just to comment on Allie, on if it's just knob and tube, they'll want an electrical report. and in compliance with any further recommendations. So if you remove that and there's other findings, they'll also require that you address those in a timely manner.
Okay, so those other findings could be completely unrelated to electrical.
Yeah, if no, specific to knob and tube, if you have a work order to remove it, when they go and perform work, if there's further recommendations related to that, they would want that addressed as well.
I see. Sure. Okay.
Yeah, we're also
Okay,
running, knob and tube obviously gets the bad rap because it's the 2 4-letter words out here, but we are running into more issues. I'm sure Ali and Ian, you're seeing this too with like Federal Pacific panels, stab lock panels. We're seeing a lot more of these on the commercial side too, on these older buildings have those panels, and those are costly, and my understanding is sometimes a little time consuming to replace, particularly if you have to wait on PG&E or Alameda Amp to come in and change the main supply line. So getting a bid on those and a timeline is really important.
Yeah, Zinsco, that's another one.
Yeah.
Okay, great. Thank you. Next slide, Genevieve. Okay. So, some people will agents have relayed to me that, they couldn't get coverage on a building with anybody, and then they talked to another broker, and surprisingly, wow, they were able to get coverage without any problems. And so can you talk about that process behind the scenes? And maybe this is Ian and Ali, is that why is it that some brokers may be able to place coverage and others can't?
Sure. No, it's a good question. And again, a couple of years ago, pretty much everyone had access to all available markets. But as new markets come into California, the process to get appointed to them has become a little more challenging. So I know with our brokerage, there's a whole regulatory affairs team that works on new appointments, and there's a lot that has to be.
And Ali, when you say new appointments, what's that mean?
Meaning like a new appointment with the carrier, so access to that carrier.
Okay.
So like we're appointed with Burns and Wilcox, or we're appointed with Travelers, for example. So on the back end, the powers that be on the broker side and the carrier side, when they get appointed together, there's a lot of conversation on basically how best to do business together. So and again, I'm speaking on behalf of that team, that when, they're adding a new carrier, they want to make sure it makes sense for both. How are you going to help us get as much quality business, et cetera, et cetera. So I don't know what it looks like with other brokers if they don't get appointed, if it's, a contractual disagreement, or if it doesn't make sense for them to work together. A lot of these carriers have certain goals even for each broker. Like you have to write a certain amount of policies or a certain amount of premium. And if the brokerage can't abide by that or can't fulfill that, then that might be another reason why they don't have access to that carrier. As a reminder, these companies are not nonprofits, they're for-profit companies. And so they want to make sure if they're going to partner with a broker, it's going to be a financial benefit for them.
Okay. Ian and Leah, anything you guys want to add?
Yeah, I can add on the wholesale side, again, in a softer market, kind of what Ali mentioned, was easier to get appointments because carriers were trying to grow in California. Now they're trying to grow in kind of a more tactical way. Then they need less, they need less distributors to do that. And with that, so what they'll look at is, one, that we can provide the premium that they need because they have, goals and budgets that they have to hit. Two, they'll look at our loss results relative to our competitors. So when we do have an event like Camp, Palisades, Santa Barbara fires, they'll look at how we performed, whether we have rate, whether we have allocation, whether we have, a good spread of risk throughout California. So they don't want necessarily a regional wholesaler that only has business in Southern California or only Tahoe. So they'll look that we have a nice reach throughout the state so that they can provide a spread of business. And then again, on a harder market, because there's a finite amount of availability with each carrier, they'll provide us, let's say, $1 billion of availability in California, and that's all they have for the state. So if they want to write 3 or 4 billion, that's an exposure, not premium. If they feel they need 4 or 5 distributors to do that, they'll pick who they feel is fit on that. If it's a more finite amount, they might pick 1 or 2. So we have programs, exclusive to us, but on the other end, we also have our competitors that have programs specific to them. So it's a business decision on less distribution, and then also on efficiencies on, they'll compare our loss results relative to competition.
There's also just mentally and physically for our systems of how much stuff we can sort of keep track of with all these different carriers too. It doesn't necessarily make sense to go out and get appointed with every single carrier who may or may not write a policy in the state, because you're not going to know their product in and out. You're not going to know their claim system in and out. And so it's also on the agent to decide, you know, the scope of their offering that makes the most sense for where their clients are mostly going to be located. Like we hate to say no, but we have to be smart with yes.
Yeah. Genevieve, next slide. Thank you. Okay, so this is a big complaint that I hear from agents. They can't get a quote ahead of time. No one calls them back, and they just want something to put in the file if you're a listing agent that can demonstrate that this home is insurable by somebody. Maybe you guys can talk about that, Allie and Leah.
So I will say we've spent probably every Thursday, Friday, Saturday, Sunday writing quotes for buyers who are going to go in what offers. I tell a lot of my listing agents when we talk to them, particularly if you have a house that you know is difficult to insure. I am not a realtor, but I would take an offer that has an underwritten insurance quote as being a little more serious than the one that doesn't. On the listing side, you know, and I'm sure Allie's the same way too, we underwrite both the buyer and the house. So the listing ones can get a little tricky, particularly if you're like, this house might have an issue or things like that, where I can put something in there, but that might not apply to the buyers coming in because of their situation, their claim history, you know, what they've got going on. So it gets a little trickier. The other thing is, once you have it, you have to disclose it. So if I tell agents this too on the listing side, if you have a house that you think is going to be particularly tricky or expensive to insure because it's a high fire line or it has these issues or it has a claim, we'll send you something, but then you can't unknow that. And so it sort of depends on how you as the listing agent want that information disseminated.
Yeah, good point.
I'm sure you've got a lot.
Yeah. So, you know, in a softer market, this was something that was very common. We were able to pull an indication and provide it to listing agents. They could put it in their disclosures. Everyone's happy. Since it's a harder market, not only is something less available, you know, less markets to just plug in some figures and get an indication, but the underwriting process has gotten a lot more stringent. So it's not just put in, you know, a fake name and an address and you pull something out. It has to be owned by a buyer, an actual buyer. To Leah's point, claims history plays such a huge part. So I can have a great indication, but then the buyer that wants to go forward with that indication has 3 prior, you know, water losses or whatever, they're declined. So they can't get that quote or that indication that was in disclosures. And there have been situations where an indication was provided in the disclosure. A buyer made a non-contingent offer because they thought they could get this quote and they couldn't. And then the next available quote or indication was, you know, even, I mean, we've seen quotes up to 6 figures, you know, so it could be a huge deal breaker. It's not always the best, in the best interest of the buyer to have this, you know, indication, because it may or may not mean anything. Another thing is with providing these indications is the carriers are looking at binding ratio too. So that's part of what makes a good partner, you know, on the broker side is, you know, when we're submitting things, they want, if they're underwriting it and reviewing it and approving it to send, they're wanting you to bind it. So they're not working for free. If, let's say, a buyer or a listing agent just wants these numbers, it takes time from the carrier side and the broker side to be able to provide these. So in a perfect world, yes, we would provide indications or even bindable quotes to a buyer prior to making an offer. But it is just something to keep in mind that I think they don't realize that it's not just plugging in the address and then shooting out a premium.
And then
oh, go ahead, Ian.
Yeah, one thing on that, you know, because again, keep going back to the hard market, but every carrier we work with, for the most part, it's not on every risk. But let's say theoretically, you know, Truckee, Tahoe's a difficult zip code for most. We're able to write, just for ease of comparison, let's say 50 homes. So if we're at 48, we start declining risks. And let's say we're at 40 out of the 50 risks, we don't capture it on an individual kind of location basis, but we will capture open quotes on a zip code or county basis. So theoretically, if we have 10 open quotes that are all hypothetical for listing purposes, we've now closed out that zip code, even though these quotes aren't really valid quotes that are out there, if that makes sense. So we'll shut it down because out of those 10 quotes, we can only bind 2. So we'll close the zip code expecting, a certain bind ratio. So we're not able to control it with, just hypothetical open quotes out there.
Just real quickly, also the last 3 bullet points here, situations where you're getting a commitment, your buyer, so I'm an agent representing a buyer, and they have an insurance commitment, and what are the risks of that not being honored, and how should they think about that in removing their insurance contingency? And the last one also is oftentimes there'll be a requirement that there's going to be an inspection after the coverage is bound and they close escrow, that there's going to be a closing insurance inspection. And so what is that involved, and what are the risks around that?
I mean, I know at my agency, we will send fully underwritten quotes to people in escrow, and we'll actually do it prior to escrow if they're putting in a bid, if they want us to. We will run their loss history, the home's loss history. We'll go ahead and put together a full bid, and so they can remove the contingency. We'll just sort of confirm that. I always suggest, again, not a realtor, but suggest going in with a contingency for insurance just to make sure. I think it's really scary not to. You just have no idea what is out there unless you've got a fully underwritten, ready to go quote. We haven't had any issues once we get to that underwriting stage where it's not honored. In terms of the post-close, that is, all of our carriers do that, a post-closing inspection. That really comes down to the agent underwriting it correctly in the first place. If we're looking at the active pictures, if we're looking at the house and we're writing it correctly, there should be no issues. We often ask for inspection reports, and generally our clients love to give them to us because they don't know what they're looking at, and I can look through that thing in 30 seconds and see the red flags and the good and bad. So we do try to really underwrite the policy so there are no surprises post-close. It does happen where sometimes we have a post-close inspection and they say, we had one the other day on a DIC policy where they said the slope was too high. So, they've given the client 45 days. We're looking at some other options. We're continuing to advocate for the client with the original carrier and looking at some backup options. But as long as we're doing correct and honest underwriting before we issue the policy, there shouldn't be problems with the post-bind inspection. But Allie, I'm sure you've got.
Yep, it's exactly the same. As long as it's underwritten correctly on the front end, no real issues on the back end or post-closing inspections. The one thing that I want to stress is, if a buyer has a bindable quote that they want to move forward, bind it right away, because there are moratoriums that are issued. So if there is a catastrophic fire or an earthquake, you can't bind it if there's still a moratorium in place. So if you have it and you've already opened escrow, bind it. You can always future bind. So if let's say you go into contract today, you're going to close May 1st, you can bind it today, effective May 1st.
And when you say bind it, what's that mean? Pay the premium?
Purchase it, lock it in. Yeah.
Yeah, and
Okay,
for most
great.
of these that are billed through escrow, it's just as simple of us basically hitting a bind button. And we get that stuff locked in. Like I said, as soon as you can, because just in case something happens and there's a moratorium, like what happened in LA.
Okay, great. Genevieve, next slide. Okay, we've gone through everything. Thank you guys so much. It was really amazing and very thorough. So Lorraine is going to be managing our Q&A. And Lorraine, do we have any questions to ask?
Yeah, we have a few. So Stephen asks, what happens to FAIR Plan if admitted carriers all leave California?
We don't want to talk about that, Stephen. No, I mean, I think that's part of and Sanjay, this is probably your question too. I think that's a big part of the negotiation with the Department of Insurance, is really to make sure that there is funding for the FAIR Plan, because if the FAIR Plan doesn't exist, we're in a whole other world of mess out here.
Yeah, and I would just add to that, it's not, I don't think everybody leaves, because again, there's money to be made here. It's just that at a certain point, because of the FAIR Plan risk and the overall risks going up too high, that's why, again, very few carriers have actually left. It's just everybody stops issuing policies. So to me, it would be more, if nobody is willing, if none of nobody's willing to issue policies, then yeah, FAIR is taking on that considerable amount of risk, which the more risk they take on, then also then impacts the ability to ever get new insurance. And that's why the whole sustainable strategy, although again, it'll take a little time, is meant to reduce pressure on the FAIR plan. So again, I'm not too concerned about everybody leaving, but we've got to get them to issue policies again. And that's what the sustainable insurance strategy is intended to do.
Hey, Sanjay, quick follow-up question. Is there any movement afoot at the legislature to allow FAIR plan to properly price the risk that they're taking in? And so this isn't an issue to all the other for-profit carriers?
Actually, they have greater flexibility than the admitted market, the other insurers, in terms of their ability to price in risk. They have greater ability. That's frankly one of the reasons FAIR plan policies are so expensive. But one way to just think about it is they're an insurance carrier basically taking on all the high risk. And that's kind of the problem. Even if they can price it, their risk exposure is so great that it's just creating too much. Frankly, basically insurance is generally a balancing of the higher risk and the lower risk. And that's how you kind of can make some money in a way as an insurance company. And they're really taking on the higher risk. I'm being facetious here, but in Los Angeles, it's been hard to get policies, even in relatively low risk areas. And FAIR has been writing, although I'm sure those will change as soon as the market gets, but I was like, well, at least they're taking on some low risk into their pool. Like that's not such a bad thing, but they actually do have existing flexibility. A lot of it is, again, there's a bill pending, which did not move forward last year, which we're optimistic about, which would give them some bonding authority, basically some further abilities to have money to back up when they're in the situation like they're in right now. That's really the key, is to just get them more solvent. And to some extent, some of the other insurance reforms that are coming that will allow them to look at reinsurance, that will allow admitted carriers, will allow greater accuracy in pricing there, but they already have greater flexibility.
Okay, great. Lorraine, next question.
What are the problematic electrical panels?
Oh gosh, it's like Federal Pacific, Stablock, Cisco.
Sylvania, I think, is another one.
Yeah.
We can provide the list of those when I have an actual copy. Each carrier has their own, some won't do Federal Pacific, but they'll do Cisco, et cetera. So we can pull together a list of those.
Yeah, there's some that are generally problematic, like the Fed Pacific, the Stablocks, and the Sylvania, but yeah, we can get that together for you.
Yeah, you guys can send that to me, and I can have our folks at the association send it out to everybody who was on the webinar. Thanks. Lorraine, next question.
What about the excellent rated insured homeowners who spend thousands, if not hundreds of thousands, to update their properties, and their longtime insurance carrier drops them? The homeowner then decides to go without insurance. How does this affect the sale? And would any back insurance fall upon the buyer if not buying all cash?
Yeah, and Lorraine, let me just add to that question, and maybe it's, so if you guys were shown a home that did not have insurance on it before, so the buyer had no insurance, excuse me, the seller had no insurance, but the buyer now is coming to you to say, I want insurance on this home that was previously uninsured. How would that impact your ability to issue a new policy?
I mean, it wouldn't really impact if a seller chose to self-insure, that's their decision. It's not against the law to not carry insurance. If there was a lender on it, they would require it. But the only time there's really any kickback if a property has not been insured is if someone let their policy lapse. But if the seller just chose not to have it, they didn't have a loan on it, it wouldn't necessarily impact a buyer wanting to, especially if it is in great condition, as described in the scenario.
Okay, so you don't automatically, you as the industry automatically view that as a black mark on that property.
Not if it's a new
Okay.
purchaser, but if the
Okay.
existing client chooses not to have insurance and then tries to get it, that's a lapse in coverage and they don't like that. But a new purchaser is fine. But to Allie's point too, and comes up, I'm sure you guys hear this all the time from your clients. They're like, well, I don't have a mortgage. I don't need to get the insurance. That's terrifying. You have 100% equity in your house. Like you have this great asset that you own. If my house burns down, well, the bank owns 50% of it. So good luck with them, right? You know, you're trying to get that, but it always scares me. I always try and talk to clients, kind of talk them off the ledge when they're saying, well, I'll just go without. Like that's a great big asset that you have 100% equity in. And let's at least find something, take out personal property, take out some of the others, let's save some money someplace, have a really high deductible, but have something.
Yeah, makes sense. Lorraine, next question.
I just wanted to add to this one. And why are we seeing pieces on the news that say that these homeowners have done everything to ensure that their properties are fireproofed and that their land is all fireproofed, and we're seeing them dropped? Do you have
Ian, maybe you can take that one.
You know, that again, you know, because of the size of these fires and the frequency, you know, 5, 6, 7 years ago, hardening on a carrier side, they're looking at a worst case scenario on these oversaturation. So we have some specialty carriers, kind of high-end, high net worth type carriers that are specific to the property, but in general, they're looking at the general area. So it's not specific to the risk. And a lot of carriers are going to have a cutoff in areas that they won't insure altogether themselves. They also have reinsurers that might dictate, we're not going to support any score above an 80 or a 50, whatever that threshold is, that's the primary factor on whether or not they'll insure the risk. So in a high brush area, it's going to be specifically oversaturation and score are going to be the two primary factors. And then they might look at that one off and make an exception, but in general, these days that, it'd be preferred, but not a primary factor why they write a risk.
Yeah,
okay. Lorraine, next.
So we're also
go
seeing
ahead.
more issues with like access roads and things like that, where they really like cul-de-sacs have become sometimes a little trickier to write because they want access points in for fire departments. Fire department ratings have become a bigger issue. And fire departments can apply to get better ratings with the insurance departments and insurance companies. So there's a lot of different factors that aren't necessarily client and house specific, but general location, broader scope of what's going on.
Edge of community would be one, as you mentioned. They want dual access. Some carriers will require the driveway to be a certain width so that the fire department can access the property. Access in itself. You have some seasonal communities that, if you have to cross a bridge and the fire truck can't access that property, that's going to be a decline altogether. So they are tightening up on that. And then, what happens is one carrier doesn't do it. And then that overlap they don't want to write what they call kind of the marginal one-off risk that will decimate a book on that kind of one loss. So they kind of stick to a box for the most part these days, where they make less exceptions they had historically. 4 or 5 years ago, those would be a one-off exception. Now it's just a hard decline in a lot of scenarios. That places it ultimately in the FAIR plan as the only outlet.
Okay, great. Lorraine, next question.
What is the scope of insurers covering homes with knob and tube? I know we discussed it a little bit, but
there's really not. I mean, it's not a characteristic that carriers want. And I think it's important to note that when the market opens up again, because it will, I mean, eventually, I don't think they're going to go back and say, we're going to write knob and tube again and wood shake roofs. Like in general, we're trying to get out of that, mind frame of, rather than manipulating or finding a way to make it work with existing characteristics, going forward, making sure these issues are addressed so that, the future looks better for the insurance companies to write on certain homes.
Yeah, Allie's absolutely right. These carriers, when they do come back in, aren't going to take this stuff. I hear that all the time from people. Well, I'll just wait and they'll take it. I'm like, no, that ship has sailed. They're not going to write it. And galvanized plumbing, I think, is the next one coming down. Because once I have a Lloyd's of London carrier that won't take galvanized, and they'll take almost anything. So I think that is a tide that we're going to see turning as well, is that they were going to want galvanized out. It's going to be the next big thing.
What about brick foundations?
Depends on the replacement cost of the home. So for homes with a replacement cost of 2 million and up, carriers want to see full 100% earthquake retrofitting. If it's under that, less of an issue finding an option. But if they wanted earthquake, it may be quite expensive or a challenge to get.
Yeah, generally home insurance doesn't cover earthquake, so we are less concerned on foundation except for the higher valuation. But yeah, you're going to get hit on the earthquake.
Okay,
And
great.
somebody else says, thank you so much. This is really helpful. Question, any advice for multi-family property buyers in San Francisco seeking to purchase?
Save your pennies. I mean, I've got a couple of, at this point, I feel like all I'm doing is writing apartment buildings that got non-renewed by State Farm. I have a stack of 15 of them coming up May 1st that we're trying to get through and stuff. We've got a bunch of I do a bunch of commercial buildings in San Francisco. We need permitted updates. And they never have them, but any kind, updated electric, updated roofs, updated HVAC, plumbing, they want to see all that. It is, I'm sure, Allie, you get this question every day. People are like, can I just take over the existing policy? No, these companies don't want that policy on their books anymore. They want to rewrite it at 10 times the price. I have someone in escrow who said, well, the seller has a policy for $4,000. And I'm like, great news. I found you a $17,000 policy. Congrats. You have a policy. And they're like, no, we want the $4,000 one. And so that doesn't exist. And I think that there's so much volatility on the commercial side, especially. And you probably see a lot more of this too, that market is really tricky right now.
Lorraine, next question.
So there are buildings, condo buildings that have knob and tube that would need an HOA decision to replace. Is the process any different for that?
Not necessarily. So yeah, the comment of the HOA making that decision is fact. So that would be something that they need to replace. The master policy eventually, whether it's going to be renewed or not, it's going to be a requirement down the line. Not as often. There are specific units that just individual unit has had the electrical replaced. So we're able to get an exception there. But in general, whether it's a master policy or not for condos, it's still knob and tube is still something that they're looking at and underwriting.
Evan asks if there is a recording that's going to be available, and I believe there is.
Yes, it will be. Genevieve will be posting that, and it's in the usual place where all of these webinars, it's a YouTube. Genevieve, can you chime in here exactly where on the SFAR site those YouTube recordings?
Yeah, it'll be on our SF YouTube channel, and Christy will also email it out to all our members.
Okay, great. So it's all members, not just people who signed up for the webinar.
Right. I'll have her email both.
Okay, great. Lorraine, any other questions? We're starting to approach the end of our time.
There's a couple. How are the LA fire losses going to affect insurance premiums to California?
They're going to make them go up.
Yep.
And then why are they not insuring Sunset zip code 94122? Is this because of the older builds?
I think it depends. I have not seen that zip code necessarily come up as a not writing, but there may have been other issues for that property as to why it went fair plan. Yeah, sorry, wish I had a better answer.
Yeah, and that type of very specific issue, it could be that somebody went to a captive agent. All they're writing for is this one specific company, and they're not writing in that particular zip code because of what Ian talked about, oversaturation. So it could be a lot of issues. So, yeah.
Yeah.
Go ahead.
Oh, to comment on that,
Yeah.
yeah, oversaturation doesn't mean it's a bad risk. It means that they've written there enough and they just put a cap on it. So Truckee would be 90210, you know, in 94161 in Oakland. So it might not necessarily be a bad risk overall, but as you said, they just kind of tapped out on that, or its score individually will take out most carriers. If you have an area that, if they're using risk meter in itself, anything above an 80, if they use kind of red zones, a different mapping system, anything above a 36, that'll take out most carriers in itself, depending on that, you know, the mapping score. But if it's non-cat exposed, it's generally 100% just oversaturation on the carriers that are right.
Yeah, great.
Um,
Lorraine?
Joel,
next.
this is Sanjay. I just wanted to quickly add about the increase in premiums. One thing to just keep in mind, though, when you hear media reports that, you know, State Farm approved 24% or whatever company, is just that keep in mind that's the average across the state. So that approval rating could mean 60, depending on where you are, or it could mean 10, depending on where you are. So just when you see that, it doesn't, you still have to wait to see how it affects you personally. Just when you hear that 36 or 24, it's not uniform. It's across their spectrum of policy. So just something to keep in mind.
Yeah, good point. Thank you.
Yeah,
Lorraine, a couple more questions.
There's a lot of questions about TICs, about knob and tube. Somebody says that they have a client that inherited a property and had to get a different carrier for their insurance company, and does a lot of equity in the property make a difference? Somebody else is asking, saying that they have a 6-unit TIC that's about ready to go on the market that has knob and tube. Is there anything they can do?
I mean, I think, and there's a question on there about what, as a selling agent, what can you do? I think Allie and Ian and I would all agree, in our fantasy world, if you can get these clients to get the knob and tube out and upgrade, that's ideal. They're not going to probably do that, right? And sometimes they'll be like, well, it's just one switch here, then get it done. But a lot of times it's a much bigger project. You're opening walls, doing that kind of stuff. I think, you know, if you can understand that that is going to impact the buyers, they are not going to be able to get a comprehensive or well-priced insurance policy for the most part if there's knob and tube. So you then, as the selling agent, and your sellers are sort of just making that decision that you're going to limit the buyer pool or limit the insurance option of the buyer pool. So if you can have those conversations with your sellers, that's great, to at least make sure that they know what they're getting into and know the risks of not replacing it. But the roof thing is becoming an issue. I'm sure you're seeing this too, where we've got carriers who, they want new roofs every 20 years. We're seeing a lot. There's a question about drones. Yeah, drones go up and take pictures of roofs. Insurance companies want new roofs. And that's just what they're saying. Yeah, that's what we're looking at.
Just to add to that, you know, I think the conversation has to change with sellers around the kinds of ways that you can prepare your home for sale. And that it's not so much about gussying up the kitchen and the bathrooms. It's about maintaining your home and making sure that you don't have deferred maintenance over time, so that when you go to sell, you actually have a product that buyers want. You know, buyers are becoming more, you know, increasingly savvy, especially if they get, you know, 3-6 months in the process of writing offers. They're writing multiple offers. They're seeing the impact of knob and tube, not only with the property that they're looking at, but just the cost of insurance, right? So I think we have to shift the conversation away from cosmetics to some of the components and, you know, systems and structure that are, I think, harder to talk about, right? And that require more research. There's a lot more liability, I think, for the seller, and ultimately for the buyer, right? So I think we have to, you know, in concert with the professionals on the panel, I think we have to do a better job of educating all of our clients on both sides about the properties that they have at stake.
Thanks, Jeremy. Great answer.
Yeah, very good. Yeah. Hey, Lorraine, I see one question in there about PEX plumbing. And for those who are not familiar with PEX, it's what's used probably everywhere else other than San Francisco and Alameda County. It's a flexible plastic tubing. Have you heard that come up, guys, that there's any issues with PEX?
I haven't.
No.
Yeah.
Mm-mm.
It's pretty much the standard of construction these days. So good to know. Yeah, and Lorraine, any last question here? We have about maybe time for one more question.
Well, let's, Heather says that she doesn't understand the role of insurance wholesalers, not admitted carriers, with the FAIR Plan being out there. If admitted carriers won't offer home insurance on a particular property in a particular area, can buyers potentially obtain insurance from a non-admitted carrier instead of the FAIR Plan? Please clarify the order of operations for buyers.
Yeah, and in an ideal situation, you know, the FAIR Plan is the insurer of last resort, so it should be treated as such. The way that, you know, the order that we do it is we exhaust admitted carriers first, then we approach non-admitted, and if all of non-admitted have declined, then we'll go to the FAIR Plan. Depending, if we know, you know, clearly that we have to go to the FAIR Plan, then we'll go ahead and skip that. But for the most part, that is the order of operations there.
Yeah, that's what Ali says, right? We are coming into a world sometimes where the FAIR Plan is a significantly less expensive option, the FAIR Plan and the DIC, because of some of the rate increases in the non-admitted market. And we're just, you know, trying to educate and advocate for our clients that that really is the last resort, and that, you know, it's not great, but sometimes we're looking at rates in the non-admitted market that are significantly higher than the FAIR Plan, and that's a tough discussion and looking at pros and cons with the client.
Yeah, and then on the non-admitted, a lot of times we can offer, you know, pretty much mirrors an admitted product. It covers all perils, no major limitations. You know, it'll respond the same pretty much every scenario. There are times we offer broader coverage as well. And there's areas that we can't write altogether. So if it's, you know, 100 wildfire score that's going FAIR Plan all day, there's areas that we can write, Tahoe, where FAIR Plan can also write with a wrap. You know, they're probably around 4,000 to 5,000 per million. We're charging around 9,000 to 12,000. So at that point, it becomes a financial decision on when it's placed. That's up to the consumer. So there's areas we overlap. You know, there's areas we're less expensive. So if you go in San Francisco, non-admitted is going to be less generally than a wrap and a DIC. If you go to high brush exposed areas, we feel they're underpriced. So most of our carriers are going to be charging more with, you know, relatively better coverage. But, you know, understandably, if you can't afford that, you know, it ends up with a FAIR Plan.
Great. Well, thank you once again. And our insurance panel and Sanjay, I know you guys are very busy, so really appreciate you taking some time out of your schedule. And then also, just a word to the agents on the call, thank you guys also for participating. I know we as agents, sometimes it's difficult to take time out of our schedule to participate in these programs, but it makes us better agents. And also with Sanjay participating also makes us better voters as well. So just really take to heart when you go into the ballot box, it's not about cheap coverage. It's about what makes sense and bringing insurers back to this state. So thank you so much, everybody, and look for that recording to be posted and pass it on to your colleagues who weren't able to participate. Thank you again.
Thank you, guys.
Thank you.
Thank you.
Have a good day.